Something happened on May 8th that confused a lot of people who watch silver and gold. A jobs report came out. The numbers looked stronger than expected, and almost immediately, silver and gold dropped. Prices fell. People watching their portfolios felt that sinking feeling. And if you follow financial media, the headlines were quick to jump in. Precious metals under pressure, gold and silver retreat on strong jobs data, and so on. But here's the thing. If you took that sell-off at face value, if you looked at the price chart and concluded that silver is weakening, you may have just misread one of the clearest bullish signals this market has produced all year. And today, that's exactly what we're going to break down together. My name is John Smith. You're watching John Smith 02, and in today's video, I want to walk you through 3 layers of this story. First, why the May 8th sell-off is more about paper trading mechanics than actual silver market conditions. Second, why the structural foundation underneath silver right now is arguably more tense than it's been in years. And third, why the coming change at the Federal Reserve is quietly one of the most important variables that precious metals investors need to understand heading into the second half of 2026. This isn't a hype video. There's no magic prediction here. But if you want to understand what's actually happening in silver beneath the headlines, this is the conversation you need to have. Let's start at the beginning. On May 8th, the jobs report for the United States came in stronger than what most economists were expecting. Before the data dropped, forecasts were running fairly modest. The consensus was that the labor market was softening, maybe cooling enough to give the Federal Reserve more reason to think about cutting rates. But the actual numbers came in hotter, more jobs added than expected. And when that happened, the reaction in financial markets was immediate and automatic. The US dollar strengthened, Treasury yields ticked up, and gold and silver fell. Now, to understand why that automatic reaction happens, you need to understand the logic that runs through the paper futures market. When jobs data comes in strong, the market interprets it as meaning the economy is resilient. A resilient economy means the Fed might not need to cut rates anytime soon. Higher rates or rates held at elevated levels mean the opportunity cost of holding gold and silver goes up because those metals don't pay interest or dividends. So in the world of algorithmic trading, strong jobs data equals dollar strength, equals rates staying high, equals sell gold, sell silver. That sequence happens in milliseconds. It's not humans sitting at desks thinking it through. It's automated programs firing off trades based on preset logic. So the price dropped. And if you only saw the price, you saw a sell-off. But here's the critical question that most people skip. What was actually being sold? The answer, in the overwhelming majority of cases, is paper contracts. Not physical silver, not real ounces held in a warehouse. We're talking about futures contracts. Financial instruments that represent a claim on silver, traded on exchanges like the COMEX in New York. And the disconnect between those paper contracts and the actual physical reality of silver is the most important story in this market right now. Let me explain that disconnect in a way that actually makes sense. Imagine you own a ticket to a concert. That ticket is a claim on a seat in a specific venue on a specific night. Now imagine that the venue only has 10,000 seats, but somehow there are 100,000 tickets floating around. The price of those tickets can go up and down based on how excited people are about the concert. But at some point, when concert night actually arrives and people try to walk through the door, there's a problem. Because the venue only has 10,000 seats. The other 90,000 ticket holders either get turned away, get paid off in cash instead, or cause complete chaos trying to get in. That is essentially the structure of the COMEX silver market right now. And the numbers are genuinely striking. As of the most recent data available through the April and early May 2026 period, COMEX registered silver inventory. That's the physical metal sitting in approved warehouses that is immediately available for futures contract delivery, stood at approximately 76 to 77 million ounces. Now let's compare that to the total open interest in silver futures contracts. That figure is sitting at roughly 550 to 575 million ounces worth of paper claims. When you do that division, you get a coverage ratio of approximately 13 to 14%. That means for every 100 ounces of silver that has been promised on paper through these futures contracts, only about 13 to 14 ounces of real, deliverable physical silver actually exists in those vaults to back it up. Now you might be thinking, well, is that normal? Doesn't the COMEX always have more paper claims than physical metal? And the answer is yes. The system is designed around leverage. Historically, the COMEX has operated with somewhere between 5 to 8 paper ounces for every physical ounce. The system works because, and this is crucial, almost nobody actually shows up to take delivery of the real metal. Historically, 97 to 99% of futures contracts are either rolled forward to the next month or settled in cash. So the concert never actually gets crowded because most ticket holders just sell their tickets or accept a refund before the show. But here's where it gets interesting. The threshold that COMEX analysts use to define stress territory is a coverage ratio below 15%. And the coverage ratio has now been below that 15% stress level for 6 consecutive months without improvement. 6 months, not for a week, not for one bad report, 6 straight months where the physical backing for the paper market has remained in stress territory. That's not noise. That's a signal. And then there was January 2026. In a single week during early January, 33.45 million ounces of registered silver were physically withdrawn from COMEX vaults. That represented roughly 26% of the entire deliverable pool, disappearing in 7 days. Think about that number for a second. A quarter of the physical silver that was supposed to be backing all those paper contracts was pulled out in 1 week. In January of this year, the delivery rate, meaning the percentage of contracts where people actually demanded real metal instead of cash, spiked toward 5 to 10%. Compare that to the historical norm of 1 to 3%, and you start to see why this matters. Each 1% increase in delivery demand above historical norms requires an additional 5 to 6 million ounces of registered metal. So if we saw a repeat of January's dynamics in a future delivery cycle, even at half the intensity, the math on the remaining 76 to 77 million ounces of registered silver starts looking very uncomfortable very quickly. This is the environment into which that May 8th sell-off dropped. Not a market with abundant physical supply, not a market where the paper price comfortably reflects real-world metal availability. A market where the paper and physical layers are operating under genuine structural tension. And that brings us to one of the broader forces underneath this whole picture. The United States is running a federal deficit that has now crossed $2 trillion annually. Think about that scale for a moment. $2 trillion. That is not a rounding error. That is a structural feature of the current fiscal landscape. The Congressional Budget Office has confirmed that the cost of servicing the national debt alone has crossed $1 trillion per year, more than the entire defense budget. That's how much money the U.S. government is paying just in interest on money it has already borrowed. Why does this matter for silver and gold? Because when a government is running deficits of this magnitude, the tools available to fight inflation become more constrained. A central bank that wants to keep rates high to fight inflation is also simultaneously making the government's debt payments more expensive. And a government borrowing at this scale needs buyers for its bonds. When real interest rates are high and uncertainty is elevated, the normal buyers, foreign governments, institutional investors, pension funds, become more selective, more hesitant. That creates pressure on the dollar over time. And historically, when the dollar comes under structural long-term pressure, hard assets like silver and gold tend to benefit. Now, this isn't an overnight process. The dollar hasn't collapsed. Markets are still functioning. But the direction of these forces matters enormously to anyone thinking about the next 2 to 5 years, not just the next 2 to 5 weeks. A $2 trillion annual deficit doesn't create a crisis on a Tuesday afternoon, but it creates a slow-moving tide that changes the landscape, often in ways that aren't obvious until they're unmistakable. And just to add one more layer to the structural picture, global silver supply has been in deficit for 5 consecutive years. According to the World Silver Survey for 2026, this year is projected to mark the 6th consecutive annual supply deficit, at approximately 46.3 million ounces. Since 2021, roughly 762 million ounces have been drawn down from above-ground stockpiles to fill the gap between what mines produce and what industry consumes. That is an enormous cumulative draw on a finite above-ground inventory. Silver is used in solar panels, electronics, medical devices, electric vehicles. Industrial demand is not softening, and new mines take years to bring into production. The above-ground supply that's been built up over decades is being consumed faster than it's being replaced. That's not a sales pitch for silver. That's just the supply-demand arithmetic as it currently stands. And when you layer that arithmetic on top of a COMEX coverage ratio running at 13 to 14%, you have a physical market that is genuinely tighter than the paper price would suggest. Now, before we go further, I want to pause and say something directly to you. If you find this kind of analysis useful, if you appreciate the fact that we're trying to cut through the surface-level headlines and get to what's actually happening underneath, I'd really appreciate it if you hit the like button and consider subscribing. This channel exists to give you this kind of clear, grounded analysis without the noise. It takes real work to put these videos together, and your support is what makes it possible to keep going. Okay, let's keep going. The third major piece of this puzzle is the Federal Reserve leadership transition, and it's one that I think is genuinely underappreciated in how it might affect the trajectory of monetary policy, and by extension, gold and silver. Here's what happened. In late April 2026, at what was widely expected to be Jerome Powell's final meeting as Federal Reserve Chair, the FOMC voted to hold interest rates steady in a range of 3.5 to 3.75%. That decision was largely expected. But what wasn't expected, what actually surprised markets, was the level of internal disagreement at the meeting. 4 FOMC members dissented from the decision. That was the largest number of dissents in 34 years. Not a one-off, not a slight variation, 34 years. One of those dissenters actually voted for an immediate rate cut. 3 others dissented because they wanted to remove the language in the Fed's statement that implied rate cuts might still be coming. They felt that given inflation pressures from rising energy costs, the Fed should be signaling that it's not in a hurry to ease. And into that environment walks Kevin Warsh, who has been nominated by President Trump and advanced through the Senate Banking Committee to replace Powell as Fed chair. Warsh is expected to be confirmed and sworn in as the new chair. His term for Powell officially expired on May 15th, though Powell has chosen to remain on the Fed's Board of Governors, which is unusual and a bit of a wild card in itself. Now, what does Warsh's arrival mean for monetary policy? This is where things get genuinely interesting. Warsh has said publicly that he believes there is room to cut interest rates. He has been associated with a more dovish tilt than some of the current FOMC hawks, and President Trump has been vocal, very vocal, about wanting rates to come down significantly. But here's the complication. The rest of the FOMC doesn't move just because the chair changes. The chair gets 1 vote on a 12-member committee, and as we just talked about, 3 of those 12 members just signaled that they don't even want the easing bias language kept in the statement. They think inflation is still too much of a concern to be signaling rate cuts are coming. What this creates is a period of genuine uncertainty, not just about what rates will do, but about who's really setting the direction of monetary policy. Is it Warsh trying to cut rates to satisfy economic pressure? Is it the hawkish bloc trying to protect credibility? Is it Powell, now a governor, who said inflation is misbehaving and that it could be months before any cut is appropriate? That kind of uncertainty is historically one of the most productive environments for gold and silver. When investors can't clearly read the Fed, when the policy path feels opaque, when the institution itself is navigating internal tension, they tend to gravitate toward assets that don't depend on any institution's decisions. Hard assets, real assets, physical stores of value that have held their purchasing power across centuries of exactly this kind of instability. Think about it this way. If Warsh manages to push rates lower faster than the hawkish members would prefer, that's a tailwind for silver, because lower rates reduce the opportunity cost of holding non-interest-bearing assets, and they tend to weaken the dollar over time, which historically lifts gold and silver prices. If Warsh is unable to move rates quickly due to FOMC resistance and inflation stays elevated, that's a stagflation-adjacent environment, slow growth, persistent inflation, which is historically one of the strongest environments for precious metals. Either outcome, frankly, lands in territory that's not unfavorable for silver and gold over the medium term. And then there's the dollar itself. When there's uncertainty about Fed leadership, when deficit spending is at $2 trillion annually, when inflation is hovering above 3% and growth is slowing, the long-term case for dollar strength becomes harder to make. Foreign central banks have been buying gold at record pace over the past few years. That's not a coincidence. That's a deliberate diversification away from dollar dependence. And if the dollar's long-term trajectory is lower, the assets priced against it tend to move higher. Now let's bring this all back together with a simple mental framework, because I want you to be able to hold this in your head clearly, not just as a pile of facts. Think of the silver market as a compressed spring. On one side, you have the paper market, the futures contracts, the algorithmic traders, the short-term reactions to jobs reports and Fed decisions. That's the part of the market that sent silver down on May 8th. It responds to news. It reacts in milliseconds. It moves based on the dollar, interest rate expectations, and momentum. This side of the market can push the spring in either direction on any given day. It's noisy, fast-moving, and often misleading if you're trying to read long-term fundamentals from it. On the other side, you have the physical market, the actual metal in vaults, the coverage ratio at 13 to 14%, the 6 consecutive annual supply deficits, the industrial demand from solar and electronics and EVs, the institutional buyers trying to source real allocated silver, the January delivery spike that pulled 26% of the vault in a week. This side of the market moves slowly. It doesn't react to a single jobs report, but it is steadily, persistently pushing in one direction toward higher prices because the math of supply and demand simply doesn't allow for a different outcome indefinitely. What we saw on May 8th was the paper side pushing the spring down. What the structural data tells us is that the physical side hasn't gone anywhere. The spring is still compressed, and at some point, it's not possible to know exactly when those two sides have to reconcile. The paper price and the physical reality have to converge, and historically, when they do, the convergence tends to be sudden and significant, rather than gradual and gentle. That's what people who study this market sometimes call a repricing event, not a gradual drift, a snap. Now, and this is important, I am not telling you that will happen next week or next month, or even that it's guaranteed to happen in a specific way. Markets are complex. There are always counter-arguments. It's entirely possible that physical delivery demand stays low for another extended period, that the coverage ratio stays in stress territory without triggering the kind of event that forces a rapid repricing. It's possible that Warsh and the FOMC navigate a soft landing in a way that takes some pressure off precious metals. It's possible that new mine supply comes online faster than expected, or that industrial demand slows due to economic weakness. These are real risks. Anyone who tells you silver is a guaranteed trade in any direction at any specific time is not being honest with you. What I'm trying to give you is a framework for understanding the conditions, what the setup looks like, where the structural pressures are, and why a sell-off triggered by an algorithmic reaction to a jobs report doesn't necessarily tell you anything meaningful about whether those structural conditions have changed. Because they haven't. The COMEX coverage ratio didn't change on May 8th. The annual supply deficit didn't change on May 8th. The Federal Reserve leadership uncertainty didn't change on May 8th. What changed on May 8th was that automated traders reacted to a piece of economic data in a way that has nothing to do with whether there's enough physical silver in the world to satisfy real demand at current prices. That's the deception in the sell-off, not a conspiracy, not a secret plot, just the mechanical reality that paper markets can and do disconnect from physical fundamentals for extended periods. And when those disconnects are as large as the current one, they tend to get the attention of people who are willing to look past the surface-level price action. Here's something else worth sitting with. Silver has more than tripled over the past year, despite this most recent pullback. It hit an all-time high earlier in 2026. It has outpaced gold's already extraordinary gains, and yet most everyday investors don't fully understand why. They see a number go up, they see a number come down, and they react. What they're often missing is the structural story that explains why the moves are happening, and why temporary reversals like the one we saw after May 8th don't necessarily interrupt a larger structural trend. The question of where you position yourself within that story is one that only you can answer. It depends on your financial situation, your time horizon, your risk tolerance, your existing portfolio. I'm not here to make that decision for you. I would never try to. What I want is for you to be able to walk into that decision with a clear understanding of what's actually happening in this market, not just what the headlines tell you happened this week. And what's actually happening is this. The paper price of silver dipped on May 8th because a jobs report was stronger than expected, and automated futures traders reacted the way they always react to that data. Meanwhile, below the surface, the COMEX coverage ratio is sitting at 13 to 14% in stress territory for 6 consecutive months. The world is producing about 46 million fewer ounces of silver than it consumes this year. Above-ground stockpiles have been drawn down by over 760 million ounces since 2021. The United States is running a $2 trillion annual deficit that constrains the Fed's ability to maintain aggressive monetary policy indefinitely. And the Federal Reserve is entering a period of genuine leadership uncertainty, with a new chair coming in who has signaled a preference for lower rates into an environment where several FOMC members just pushed back against exactly that direction. These are not small variables. These are the structural pillars of a market that in the paper layer briefly looked weak on a Thursday morning and in the physical layer hasn't changed at all. Let's close with this. Every market has moments where the price and the underlying reality diverge. The divergence is usually temporary. The question that determines whether you benefit from it or get hurt by it is whether you understand which side of the divergence you're standing on. People who sold silver on May 8th because the jobs report was strong made a decision based on the paper layer responding to short-term news. People who understand the structural picture, who looked at the same sell-off and thought about what actually changed in the supply-demand picture of physical silver, saw something different. They saw the spring compress a little further. Whether that spring ultimately delivers the kind of repricing that the structural data seems to point toward, that's for the market to decide, and for all of us to watch carefully. But if you're going to watch it, watch the right things. Watch the COMEX coverage ratio. Watch the delivery rate each month. Watch what's happening to above-ground inventory. Watch how the Warsh Fed handles its first meetings. Watch the dollar. Watch the deficit trajectory. Don't just watch the price on a given Thursday morning and conclude you know what the silver market is telling you. Because on May 8th it was telling you something completely different than what the headlines suggested. That's what we're here for on this channel. Every week, we try to cut through the noise and give you the actual story underneath. If you found this video useful, please hit that like button. It genuinely helps other people find this content. Subscribe if you haven't already, so you don't miss what we cover next. And drop a comment below. I read them, and I genuinely love to know what you think. Do you see this sell-off as a buying opportunity? Or do you think the structural concerns are overstated? Let me know. I'm John Smith. Thanks for watching John Smith 02. I'll see you in the next one.